Well, ladies and gentlemen, welcome to popcorn season. Welcome to short squeeze season. Welcome to Slay the Bears and the Doom and Gloomers season. This is We Talk Money, and we're here to, I don't know, what are we here to do today, this week, guys?
Well, we're here to talk about a very busy past week and half week that we've been in this week with data, with short squeezes, with crypto moves, it's getting a little crazy out there.
We'll take a little stab at Dave Ramsey here in a second as well. I mean, he just makes it so easy, but what has happened? So over the past week, we've seen a big short squeeze in stocks. We've also seen Bitcoin's bull market continue. Altcoins are starting to get some love. Is inflation really down, or is the government lying to us? Man, I've seen some conspiracy theories and maybe some truths. I don't know. I want to dig into that as well. But what do you guys think is the TLDR of the last week? And what are the most important things that people need to have on their radar for the end of the year?
TLDR is the Bears have been put into hibernation for the winter.
Ooh, that's a strong statement.
That maybe is a little bit of an aggressive statement, but it's very clear that the market is finally coming around to the idea that the Fed is done on rate increases. It's coming around to the idea that rates may actually be headed down next year. A lot of people were still very skeptical of that. The higher for longer camp was out there loud on Twitter over the past few months, but we're now seeing it in the actual data, what we've been predicting here on We Talk Money for a couple of months now, which is that there was a little bit of head fake in the inflation numbers over the summer. And now we're headed back in that downward trend. And so we could talk about some of the components. There's definitely some funky stuff within the calculations of the CPI. That whole weird thing with the healthcare number was certainly strange. But overall, we are seeing a lot of categories deflating. It's not just, in my opinion, it's not a story of the government manipulating data, because we also got the PPI today, and that confirmed what we saw with the CPI. If you look at other countries' inflation data, it's also coming down. So I don't think really there's an argument here that it's just manipulation of the data, even if there is some wonkiness with some of those parts of the data. But wow, what a day in stocks yesterday. I mean, the Russell index was up 5.5% in one day. That's the largest increase this year, and I think the largest we've had in almost 2 years. So it was a pretty wild day. I saw a lot of stocks up over 10%. We've got some follow through today as well, seeing a lot of strength in stocks again today. And the question is, do we rally into year end? Do we get this plus the Santa Claus rally? I think that's what a lot of people are asking themselves. Personally, I get a little bit more cautious after we have rallies like this. I think it's nice to take some chips off the table in some areas and be a little bit more measured in how we're approaching the portfolio. You don't want to get total YOLO mentality yet.
Yeah,
which is easy to do.
The S&P and the NASDAQ have made about a 10% run over the past 2 weeks. And for you guys that are watching the video, you can see that prices now gotten above that 100 period moving average and made a higher pivot high. So according to just very simple technical analysis, we are back in bull market price structure. Now, as we know, there's a difference between the stock market and the economy. So we can check in with Nikki and Trav on the macro view of the economy. But as far as price action goes, markets are looking very strong. Also, Bitcoin getting a pop today, continuing its trek towards 42K. What other data have you guys seen over the past week that is either telling or confusing, confirming or contradicting what we've been thinking?
I feel like I've been all year talking about the good and the bad, tug of war that could keep the market afloat and trading in a range. I feel like that's been my general statement for, a very long time now. And what I'm seeing now is essentially the consumer has officially normalized back to pre-pandemic levels when we look at things like, looking at things like credit card delinquencies and charge-offs, right? That the banks have to deal with. There's been a lot of buzz over, the past few days about how these delinquency rates have gone up and charge-offs have gone up at the major banks. But what they're not saying is some of the major banks are actually seeing just delinquency rates return back to pre-pandemic levels. So October, 2019, December 2019, before the pandemic happened, a lot of the people that are, late on cards and what the banks have to deal with because of that, it's back to pre-pandemic levels. There are a few banks though that we are seeing a little bit higher than pre-pandemic levels in terms of, delinquencies. So what that's telling me is, yes, the consumer is slowing down. We do have to be very aware of that, but it's not an across the board thing. And the whole theme here is still, we are normalizing. We are, if not still normalizing, we're normalized in many areas, right? But in many other areas, things still look okay. Certain banks, bankruptcies, for example, are still way below pre-pandemic levels. So again, back to that tug of war of the good and the bad. Now, what I think is going on in the stock market at the moment with this rally is we had that 4,200 level in the S&P 500 that, we talked about over and over. Fake out breakdown, right? Shorts go in hard. They were super bearish. We were talking about valuation actually being okay. It wasn't super expensive, but it wasn't cheap. It was kind of a Goldilocks valuation. So, with all of the economic data mixed with the valuation of the S&P, that's kind of where we were landing with our thoughts. Now we've got the Fed, who is kind of able to pound their chest of controlling inflation. Inflation is coming down still. And now we have the potential for them to lower rates because the consumer is slowing, right? So now the market is pricing in, it's squeezing shorts because one, we've got the potential for housing to boom when the Fed potentially cuts rates next year, which is looking more likely, and I believe it's being priced in as well, that we're going to start seeing rate decreases in 2024. So they're pricing rate declines that could potentially spark the housing market to boom again. The housing market is the economy. We are seeing growth estimates, in 2024 not looking too terrible. And even if they come down, they're still going to be better than 2023. And if I'm not mistaken, we have China sales data or retail sales data starting to improve, I believe. Trav, correct me on that if I'm wrong. So we have China starting to come back into the market as well. So that's my take. I think that there are a lot of forces, and then all the people that got short that just wanted to hammer this market to the downside because they were super bearish, they're screwed because they weren't paying attention to all of the information. They were looking at only the data that was confirming their bearish narrative. So now here they are missing out.
Can we talk about Michael Burry for a second? And how I believe he lost, what, 600 million on the short? Did you guys see this the other day?
Yeah, unfortunately, the way that his trades are reported are incorrect. And so it's funny what makes the rounds on Twitter, because, I did a video a couple of months ago on this when initially it came out that he'd bought a ton of puts on the NASDAQ and the S&P, and
it was short like $6 billion or something crazy.
Exactly. That's what people made it look like from, the 13F filings are flawed in the way that they present options positions. And so people think that his short position via long put options was the same as if he was short that notional amount, which he was not. Anyway, you can go watch that video that I put out on Stocky TV if you're interested in the details. But basically, the numbers are far inflated beyond what they actually are. So I think, he lost probably somewhere on the order of a few $1 million to maybe 8 figures, but not in the 9-figure plus range, because his whole portfolio, I think, is only worth, 400 million. So yeah, it's really interesting though, the bear narratives here that have been circulating all year around Burry, around, every negative thing that possibly pops up every month, whether it's like, oh, you mentioned a few of those already, Nikki, like consumer credit delinquencies that have been ticking up.
Bankruptcies. Yeah.
The banking crisis was a real one we had earlier in the year. That one was certainly pretty scary. And interesting that we moved past that one so quickly. But, other things like de-dollarization and all these other narratives that pop up every month that basically just get invalidated very quickly. I will say this, Nikki, you made a few interesting points, and I wanted to add some context. The credit card data is kind of interesting. So October numbers continue to rise, and we've been talking about how last year they were way, way low by historical standards. And we were talking about how this is a normalization of credit card delinquencies back to pre-pandemic levels. But they're not stopping. They're not really slowing down. So at this point, it's like they're getting now back to those levels that are in line with pre-pandemic 2019, but the rate of change is not really slowing. And that's a little bit concerning because that means that we may overshoot normalization levels. We may overshoot normal here relatively quickly. And this is one of those things that I've been talking about where I think 2024 is going to look a lot different. We're moving from 2023's playbook and 2022's playbook of people worried about inflation, focusing on the Fed and rate hikes. And we're going to start to shift into, well, is the economy really as strong as we think? Is the economy weakening? Did the Fed go too far too fast? Is the Fed going to be able to adjust their policy quick enough? Because right now, Jerome's still out there talking very, very tough about inflation, saying that the Fed may still need to do more. Now, maybe he's changed his tune a little bit since the data came out this week on CPI and PPI, but I'm concerned that the Fed will once again be behind the curve, that they've already done too much, and that the damage to the economy because of the lagged effects of everything they've done will become more evident in 2024. So right now, we do have 2024 earnings estimates that look really healthy. We have retail sales still growing at about 2.5% year over year. But, and by the way, we do have inflation numbers cooling. But what if we move into a situation where these credit card delinquencies keep rising, where consumer spending slows even further, where the Fed's still up at 5+% on rates and it's choking off the economy, earnings numbers start to get pulled back down. We could find our situation, we might find ourselves in a situation in stocks where, we were so optimistic about inflation numbers coming down. Well, now we got to worry about deflation and economic weakness. And that, I think, is where the playbook shifts into 2024. And investors should really think hard about their portfolio. And frankly, this Russell move might be a little bit overdone because of that, because small cap stocks will probably suffer if we do go into more of an economic weakness environment. So interesting to think about. Again, I think the main takeaway for me is that the 2024 playbook is going to look a lot different than 2023.
Well said. And let's just jump into the charts and take a look at what I guess you mean by, the Russell being overdone and where the strength has been and where it's weak. So if we take a look at the NASDAQ, as of right now, the NQ is basically at all-time highs. Like it's really damn close to it. If not tagged it, I don't know. I need to zoom in further, but look, we're right there at all-time highs. And if we look at the FANG Plus index, which is basically the top 10, that is also right at all-time highs, where, the S&P, this is still large cap, but it's a little bit lower. It's a few points off of all-time highs. But when we look at small cap, this thing is still significantly off of all-time highs, right? It's, as of today, about 25% off of all-time highs. So small cap has absolutely just been lagging and getting demolished. And yeah, it had a bounce, but when we look at the chart, look at where it is. We're coming off of a 12% bounce, but we're still below and using resistance of the 100 and 200 period moving average and still making lower lows and lower highs. So this is pretty weird that large cap tech is still running the show and everything else is suffering.
Yeah, and I want to believe in the idea that small caps, it's their time because they have underperformed for so long, and the mega cap tech stocks have really been outperforming so much this year. And so it seems like, yes, small caps are due, and they could continue to have a long way to go and a long way to run as far as capturing some of the the outperformance finally. But I don't know. I'm not sold because when you look at small caps and the construction of the small cap indices like the Russell 2000, they have a lot of stocks that are very economically sensitive. And so if we do get into concerns about the overall economy, it's hard for me to envision a scenario where small caps outperform on a medium term basis. And so that's where I'm still, a little bit unsure that this really has legs to it as far as small caps and their outperformance. We've seen a lot of fake outs too with small caps where they've had a couple of days of this and then the mega cap tech stocks just blow them out of the water again. So typically what you see too is like, you'll see small cap indices outperform much more significantly and much more broadly once you're starting to get to an economic bottom and you're coming out of a recession. I'm not clear that we're at that point here. So that's, again, why I'm a little bit cautious on the small caps, but valuation wise, they still do have a lot of relative attractiveness.
Yeah, it's really interesting. I know you've also been doing some work on Bitcoin miners. We can talk a little bit about crypto as well, but miners are one of those things that I guess are sensitive to economic conditions, but also more so tied to like the price of Bitcoin. And recently we've been seeing Bitcoin miners actually trail Bitcoin. Bitcoin had a pretty big move here over the past month or so, just since really like mid-October. So about 30 days ago, we've made about a 40% move in the price of Bitcoin, where a lot of the miners are still kind of flat and kind of trailing that. And I know we've been talking about this in the community. As of today, things are actually starting to catch up a little bit. We've got miners that are up, anywhere from 5 to 15% on average. So are there any things that are kind of standing out when you look at this sector, or you still doing some work on it?
Yeah, still doing work on it. I'm going to put out a video on that hopefully late this week. But the big event, I think, is the halving next year for the miners. And I think that may be why we're seeing this underperformance. So interesting to note, too, that on a year-to-date basis, the miners are still slightly outperforming underlying crypto prices like Bitcoin. But in the last 3 months, they have vastly underperformed. And that's unusual, because typically when you are in a bull cycle and you see a quick move up in the underlying, like we've seen in Bitcoin, you will see the miners go ballistic and you'll see them rise, multiples of the underlying in a strong bull. But the halving kind of throws a wrench into that. If you go back to previous halvings, particularly like the 2021, which is a little bit funky because you had COVID in the middle of it. But if you look about a period from about 6 months pre-halving, the miners really underperformed the underlying like Bitcoin in the 6 months leading up to the halving. Then around the time or just before the halving, and then for the next 6 to 12 months after the halving, the miners massively outperformed. Part of that, again, may be due to that big post-COVID rally we had, the 2021 exuberance. So it's hard to kind of tease out exactly what the relationship is given the time period we were in. But it does seem like if we look at the last halving, the miners did underperform leading up to the halving and then way outperformed after the halving. So that could be what we're seeing here lately, is the Bitcoin mining stocks have been underperforming as we approach the halving next year. And, it could continue for a while. We've still got a number of months before the halving next year. And so the miner trade, it might still be a little bit early. So that's worth keeping in mind.
It's good to know. That's something to definitely keep on our watch list and keep in the back of our mind. Let's just talk about crypto in general, shall we?
Yeah.
So taking a look here at the Bitcoin dominance chart. So one thing that we know typically happens is after Bitcoin makes a big run, so we had, like a 40% move, what happens is a lot of capital comes into Bitcoin, right? People buy Bitcoin, the price goes up. What happens is some people will start to take profit. And this week we saw, 4 red days in a row, a little bit of a pullback until the bounce today. And on that pullback, if we look at Bitcoin dominance, and it's actually a little bit longer than that, but Bitcoin dominance has actually been falling, which means that some people have been taking profit out of Bitcoin and putting that into altcoins. So if we look at, total 2 and total 3 chart, this is the crypto market cap excluding Bitcoin, and then total 3 is excluding Ethereum as well. But you can see there's been a nice leg up there too of about 30 to 35%. So we've started to see what I call popcorn season, where we're getting, larger cap that is also broken out, like Solana, ETH has been ticking up. And that capital is also starting to flow down to smaller caps. So I did a video on my YouTube channel yesterday talking about this, and how about half of my watch list is cryptos that have not broken out yet and are still in those like accumulation ranges. And then about half of my watch list is tickers that have already broken out for the first time, and I'm looking for continuation patterns there. So I'm still not convinced that we're in a full-on altcoin season yet. I've done some analysis on the charts, what would actually signal that for me. But we've still got some headwinds as far as like, the exchange situation and the regulatory issues here in the US. But I don't know. Everything's still lining up. Every market cycle, I'm like, I don't know if alts are going to come back. And every time they do, and then some. So we'll see how the madness of the crowds drives these prices over the next couple of months and then through the halving. But so far, I mean, my Bitcoin play is just continuing to do what we've been talking about all year. It's just trekking higher and, giving us runs, retracements, and extensions to the upside. And I don't know. It's just hard to be a bear. I can't see how anybody right now would be bearish on Bitcoin.
It is very interesting right now to watch these risk assets like Bitcoin and stocks just have such strong bullish technical analysis. Like you can look at all the, fundamentals all you want, but when you look at these charts, people are throwing money into risk assets still. And that is something that I'm like, it is a little bit puzzling because just this continued confusion that we've all been dealing with the consumer and, the retail sales data not matching up with what, we're seeing here or there and everywhere. And it's like, okay, so yeah, people are still throwing money into risk assets. What does it mean? Like, what does it mean, Travis? With the way things are, what does it mean?
The other weird thing too is, in addition to like just risk assets, people want to buy real estate. And Trav mentioned earlier that, yeah, if rates come down, is that going to create yet another boom in prices? And I've been wargaming out like all the possible chess moves in the real estate market. And it just seems like, yeah, like until supply massively catches up, I don't see prices crashing much further than they have so far.
That's been one of my arguments too, is if housing prices hold up, the equity that people have built in their homes, which most people that, aren't in the top 10% or hell, even more than that, maybe the bottom half, right? In terms of wealth percentile, most people have their wealth in their home. And so I've been thinking a lot about this. Even if we have the consumer weakening, they've got equity in their homes that they didn't have in 2008. And they didn't have even when the pandemic happened, right? Because all the prices spiked after the pandemic had started. So it's just an interesting thought thinking about how the only place to really go from here in most real estate markets is if the Fed does lower rates. I don't see how we don't have a frenzy. I don't see how we don't have people just like chomping at the bit to purchase homes, because as we've done the math and we know, you could be better off with lower rates and a higher price than, vice versa, higher rates and a lower price. So, depending on the rate, of course. But I don't know. That's something I've thought about a lot, is at what point are we going to see consumers start to tap? Actually, we're already seeing them tap into home equity, but at a higher rate. And that is going to definitely show that the consumer is struggling and kind of grasping for straws at that point. But the point is they have it, and it doesn't seem like it's going away. So how does that lay the foundation for, potential recession in 2024 too? Just things that I think about.
What are the things, like, if you had like a short list of things that you would look for as real signs of weakness, not just all the stuff that's been popular on Twitter lately, but like the things that maybe are underappreciated or that would be actual like bellwethers for a truly scary situation?
I mean, I do think things like the credit card delinquencies and some of those real-time metrics are super helpful. I think we have already seen, some concerning signs at the low end of the income spectrum. And really that's where I think we often see it happen first, because, the top, call it 25 or even top 50% of income and wealth in countries like the US, typically does have some assets. They're actually benefiting somewhat from high rates. And so, that's relatively shielded. If you start to see some of that crack at the higher end, I think that's where you really start to get concerned about the overall economy. We always look at corporate earnings as well. And what's happening there in terms of revenue trends and also just earnings trends overall. Business investment's another big one. And we're not really seeing anything in the data there that suggests a very rapid fall off. We've had some cautious guidance, but other than that, we saw a very rapid shift to job cuts in 2022 among big tech companies, but we just haven't seen a lot of that this year. So we're watching things like that. Certainly the job market is one thing that's held up fairly well this year. So we're always looking at things like weekly unemployment claims, basically looking at these very forward-looking indicators to see if there's anything that's rapidly changing. Nick, you mentioned an interesting thing there around the housing market. I think that's why actually the Fed will be very slow to reduce rates in 2024. I think they're afraid of this 1970s situation where they thought they had inflation under control, and then there was a second big spike up. And so they're going to use that history as a guide to be very slow about reducing rates. So, that I think will continue to be a big headwind. The other things that really happen quickly in the economy are typically come from something like the banking sector. Luckily, this time around versus 2008, banks are a lot healthier in terms of balance sheets. And if you do get rates coming down, that actually helps the one big worry we've had about banks, which is their bond portfolios. So, yeah, it's hard to imagine right now anything other than some black swan event, a major war breaking out between the US and China, or, some sort of like massive meteorite or asteroid or something like that.
Okay, so I was actually going to pivot into this. I have a black swan idea.
Okay.
And it's something that is not unknown by everybody. Like, I'm sure everybody has heard this in some capacity, but I've been thinking a lot about it. I've been doing some more deep dives on thinking about post-labor economics.
I know where you're going.
Yep. So talking about AI and all the stuff that's been happening, I've been closely following a lot of the thought leaders in the AI space. And there are several guys that are ringing the bell that AGI is much closer than we think. And even trying to properly define what AGI is, people have different definitions, but there are a couple of people that I've been looking into that are claiming that basically all definitions of AGI will be satisfied within a couple of years. And some people have been talking about what that means. And this term, I think you're going to start hearing it more and more, post-labor economics. Like, what happens when human labor is not really required in the economy? And I don't know how close this is, but what I do know is true is exponential gains. People tend to underestimate how fast things can change, right? Like the R naught, like with a pandemic or something, like how exponential numbers work. Most people think linearly, and they think, what's the rate of change that we've had over the past decade is going to be the same in the next decade. But I've been thinking a lot about the economic numbers and what this could look like. And we know that the unemployment rate had this big spike during COVID, and then it kind of came right back down. And if we look over the past, 80 years or so, unemployment tends to chop around in between 3 and 4% on the low side, which is where we are now. And then, 7 or 8%, and it can get up to, 10% in the extreme examples. And I know some countries are dramatically different than this, but the one thing that has been trickling down and that we've talked a little bit about on the show is the labor participation rate and the amount of people that don't show up on the unemployment rate because they're just not looking for work. And what if this labor participation rate comes way, 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 way down, right? Like it's historically been in between the low 60s to high 60s. But what if AGI and artificial intelligence in general causes a collapse in this over the next, I don't know, several years or decade or two? What does that look like for the unemployment rate, the labor participation rate? And I don't know. I haven't come to any conclusions yet, but it is just probably, in my opinion, the biggest black swan potential outside of financial markets. What do you guys think?
I'm a little bit more of an optimist on this. One, I don't think it's interesting. You did mention there's different definitions of AGI. I'm less worried about a runaway AGI. I think there's physical constraints in the real world that sort of prevent that fast runaway that people worry about from sci-fi novels.
Mhm.
I do think we're just on the front end of a massive wave of, LLMs and AI software being implemented in the workplace that could actually cut a significant amount of jobs. However, like right now, we're mostly seeing that AI is still being used as a supplement and sort of like an agent level, assistant essentially to a lot of jobs. And so it will make people potentially a lot more productive in their existing jobs. So to me, it's not clear yet that like we have a massive unemployment wave coming. I thought a lot about this, by the way, like for more than 10 years. Like I invested in a robotics company through an angel investment, I think around 2015. And, that company actually just shut down, and it was,
Is that the hamburger company?
Yeah, it was called Creator. Before that, it was called, I believe, Momentum Machines, a company out of San Francisco, a bunch of Stanford and Cornell roboticists. Basically like an amazing team, but, really had a difficult time making the economics of it work. The hardware itself is very costly. Even if you look at things like Tesla's humanoid robots, you think about aspects of safety. Are people going to allow that? Are regulators going to allow that in the home? I think we still have
I hope not.
You're right. Yeah. So
we just watched Tim the other day. Did you see that movie?
I haven't seen that one yet, but yeah.
It's creepy, man. Yeah. The robot basically turns into a murdering, like dystopian hellhole.
Freaking kills everybody.
Yeah. I think that's what we're all worried about, right? But yeah, I think so. I think when you think about things like LLMs in the software world, where we've seen a lot of progress in the last few years, the transition from that to real world, atoms-based AI and robotics jobs, I guess you could say, I think there's still a very wide gap there. And so I question the economics of that too. Like you think about like a humanoid robot that's going to cost 50 grand. It's going to take some payback. Maybe people lease that over a period of 10 years or whatever to make that more palatable. But, I think we're still a ways away from that. But you asked the right question. These are the things we should be thinking about. Like these are the things like what can change quickly that no one is expecting, because that's the kind of thing in investing that can make, that one trade that sets you up for life or, generational wealth from one trade. And so I love the question, and I think we should continue exploring it. But yeah, I don't know. I tend to be a little bit more optimist that we'll create new jobs to go along with like the new technology that we have. Cause that's just like, that's happened literally in every other period of humanity for the last 300 or 400 years, even though everyone was worried about, horses going away and the automobile, and everyone was worried about, the printing press and farming equipment and mechanization of farms, because it used to be that everybody, the majority of people worked on farms, but, it worked out okay. So I'm a bit more of an optimist there, but I think, again, good question to ask.
It's definitely something just, I guess, on an individual level that people should think about is like, well, what career am I in or thinking about going into? And is it at high risk of getting automated? I mean, a few years ago, even the AI experts were all predicting that it was blue collar work that would get automated away first. And what we're seeing is it's very much white collar, right? Designers, coders, even consultants and different ways. Like think of attorneys, right? Like there's obviously, at least for the next several decades, going to be a very real need for a human attorney to go to court and argue. But like for your average, like contract creation or document review or LLC formation or all of those types of things. I mean, I don't know what percentage that makes up of an attorney's practice, but a lot of that stuff is going to be automated out. And for a $20 subscription, you can do it yourself over, paying a couple $100 an hour or whatever. So I'm just thinking about like, what can we see on the horizon that's going to get automated away? And I know the whole saying is, AI is not going to take people's jobs. It's people with AI that are going to do that. And I think that's true maybe in the short term. But one thing that I'm thinking about is like the AI agent swarms, and when they can start spinning each other off and, stuff that still seems very sci-fi today, but I'm trying to see out a little bit. Just trying to figure out, like what is hysterics, what is overblown, irrational, never going to happen stuff. and then what is like the underappreciated real risk that people aren't seeing. It's a fine line, right? And a lot of it is guessing, but I like playing that game. So
have we thought about, like, could this be, you know how right now we've got income jobs across all income spectrums, right? Lower income jobs, higher income jobs, middle. Could this just be something that pushes more people to be required to learn more or go to school for something very specific, robotics or, engineering or whatever? We need more of that to be able to sustain this new AI world. So the lower income jobs essentially kind of get pushed out because they can be done very easily, as we're seeing with McDonald's and other places that are implementing that already. And people have to just come out of high school and go into college with kind of more ambition, and they have to really, they're kind of forced to level up in terms of, I need to work a job that's going to be more skilled, higher skilled, right? So it could end up just pushing a wave of people and encouraging them to be more educated. And like, there is no lower path. There is no low income path. Every job just kind of gets bumped up to something a little bit more high level. Does that
I
make
think
sense?
anything that can be automated will be automated. So yeah, I think that's true. Like any of the paper pusher jobs are probably going to get, yeah, I don't know.
People are
I think people will
essentially,
have to focus on like more on lifelong learning and having
yeah.
multiple careers. And I hope Trav is correct that like this is going to bring more opportunity and new opportunity as opposed to just leaving, tens or hundreds of millions of people unemployed. But
And we've talked about how, blue collar jobs may be the most safe. And that's kind of, I think, relevant to the point I was making earlier about, the world of atoms being a little bit more difficult to replace right now, even with, the breakthroughs in LLMs and AI that we've seen recently, because, is your plumber going to be replaced right now? Does LLMs, does OpenAI have does it pose a threat to your plumber or electrician? Probably
Not at
not
all.
any time in the near term, right? So I think on that end, you've got an interesting, defense. And then I think where Chris mentioned maybe the biggest risk is somewhere in the, the white collar spectrum, where you've got things that could probably be done a lot more efficiently or automated with AI and AI agents and chaining together agents. So that, I think, is definitely where people should be asking questions about. One, do I need to add more skill sets? Can I get more efficient? Can I actually utilize these tools to make my skill set, more valuable, or to make myself more valuable? And that I think is a good focus. We also, I think, we've talked about this before, but the university system, particularly in the US, is sort of in no man's land. It's kind of broken. And I think this has been true for more than 10 years, but now it's becoming quite clear something is going to change a lot in the next decade or two with how people train themselves and go to university and what university even stands for.
yeah. I tweeted this the other day. I said the 2000s, the message was go to college. The 2010s, learn to code. 2020s, become a plumber. But
It's
I
true.
went on to say, I said, well, the ironic thing is like the first two didn't future proof your career, right? So, a lot of us that graduated high school in the early 2000s, like a lot of people got degrees that were kind of worthless. And then it was like, oh no, learn to code and you'll always have a job. Well, AI is kind
Yeah.
of disrupting that. And then like 2020s, yeah, it's like, oh yeah, just become a plumber. And even what we're saying today is like, your job is probably not going to get disrupted, but with exponential growth, what if it does? What if in 2 or 3 years there are fully functioning like electrician and plumber robots? I don't know, man. This is where my mind goes.
I don't know. I think there are certain industries where it's maybe too intricate, and like a robotic touch just isn't isn't good enough. Like, you need that, like the human touch is the only thing that can fix something, and like we can critically think, and robots, I mean, robots can do a lot, but I don't know. I do side with Trav that I'm a little more optimistic about it. And I hope that humans are unique enough that we are still very needed.
Well, and but
across many
okay,
industries.
let's say say we're not though. Say like my situation plays out where it's like robots are like the just so capable that we enter this period of post-labor economics where it's like humans don't really have to do anything. And then like, okay, let's say we figure out UBI or like some kind of socialist dream that actually works, right? What does that
More
mean? Well,
inflation.
we get to focus on fun shit. We get to play pickleball and, I don't know, go for hikes all day, every day. I don't know. That'd be kind of a cool utopian world that probably has a very, very small probability of actually playing out.
That would be pretty cool. I do think it'd be cool to have, AI open up new frontiers too, like make new discoveries, create the ability for humans to become interplanetary on a much faster time scale. That would be really cool. Like those kinds of things are the things that like I dream about. But
Nice.
it's also not clear that is really in the near future either. But that would be my dream. Yeah. It's like, we can't even imagine the worlds it opens up. And, I don't know, maybe, the idea too that like humans and robots or humans and machines or human and AI kind of become one and the same over a long enough time frame is really interesting to think about too. Like, humans becoming kind of a new species at some point with a new level of computation. That could be pretty cool too.
Yeah.
Because we're pretty flawed and we're pretty dumb and we have all these wars still. It's like, what are we doing? Like, are we really progressing? Like, I don't know. Sometimes it doesn't feel like it. Sometimes I'm like, maybe it's not all of like, maybe the human race as is isn't what we should be rooting for. Maybe like humans plus AI creates some new superhuman race that's like even better. I don't know.
Would you be a beta tester for Neuralink?
Hell no. I'm not going to be V1 or generation 1 of that, but hey.
Oh man, what if
to.
No, but I guess the advantage is like, what if you did that and then it was like the Limitless movie where all of a sudden you're like, you can predict every single market with like precision accuracy. And you become the wealthiest guy on the planet.
Yeah, no, you're right. The potential there to like advance yourself beyond everyone else is pretty cool.
Hell yeah.
You'd be banned from trading. Congress would ban anybody.
Oh, I can totally see them doing that. Like well, I don't know. We've got robots that trade the markets now, so
yeah.
Anyone that hasn't watched that movie, Tim, you should definitely watch it. It's pretty eye-opening.
How does it compare to what was the one a couple years back with the other humanoid robot?
Her or her?
Yeah, was it or her was the one with Joaquin Phoenix or not Joaquin Phoenix.
Yeah. That's the one where it's basically what we have today with the AI that you can interface with and have conversations with.
And
this
then
is more like
there was another
one here.
Yeah, there was another one with a female robot that like becomes let's see, what is it? What's the name of that one? Can't believe I'm forgetting. But it's one where there's this like, guy goes to this billionaire's like secret house or whatever out in the middle of nowhere, and he's got this like female girlfriend robot thing, and she eventually like goes on to I don't want to spoil it.
I don't remember that one.
I don't remember that one either, but this one, it feels like it is what we're moving towards, and that's what's so freaky about it. A lot of the things that they show, like the the self-driving cars, like that's definitely in our lifetime. We're already seeing that progressing. And
the premise for the movie is he's basically like your assistant. He's there to like do anything you want him to, but then he like kind of develops this like really evil
we don't want to spoil it
mode. We don't want to
spoil
just leave it at that, but yeah, go watch it. It's pretty freaky. Yeah.
Okay. And Ex Machina is the other one.
Oh yes.
Yeah. Really good movie also. Pretty dark.
Okay, I'll have to add that one to my list.
Ex Machina is the other one I think might be in the similar realm.
Cool. All right. Well, I know we went off on a tangent. I just think, something that threatening to everything is probably worth a discussion. So
yeah.
Thanks for hanging in there with us guys on that one. Let me know if you have any other loony predictions or if you think I'm Am I right or are they right?
I
'Cause
don't think it's loony. I think that there are both both sides. There are truths.
yeah,
And then there's definitely a concern about, employment for sure.
definitely.
That could be a huge black swan.
Yep.
Hmm.
Yeah, I don't know. It's definitely something to think about. And at a minimum, the tools are cool to use. At a maximum, it's going to disrupt everything. So, all right. So we've got markets that are close to all-time highs, and we've got Bitcoin, which is still well below all-time highs, and we've got alts that are starting to catch some steam. And earlier I said the NASDAQ was close to all-time highs, but it's still a few points off. So, yeah, what are you guys looking forward to over the next week? What should people be thinking about, looking out for? We've been working through earnings season. We've been working through the Fed stuff. We're getting closer to the halving. What else is on y'all's radar?
Got Nvidia reporting earnings here in a couple of weeks, and that's always the potential for fireworks.
Yep.
Let's see. I can't remember their exact
It's
earnings date. I'm gonna pull it up here.
it's already backed all-time highs. That's crazy.
Yep.
Yeah, you remember like a month or two ago when it was going viral on Twitter that Nvidia was like cooking the books and there were all these
Yep.
conspiracy theories and it was going to crash the stock and Jensen selling and
Yep.
God,
Remember all of it.
some of those people, I just I don't know how they have such big followings when they put out such garbage.
I
But
think people just love the fear porn.
yeah,
I mean, my God, man, anytime I post something negative, it definitely gets more engagement. And we've talked about this off camera, how Twitter is kind of chasing or modeling their algorithm after other social platforms that reward stuff that makes you angry
Yeah.
or polarizing. And the quality tends to get pushed down. And people just love the fear stuff. I think at a certain level, it makes them feel better if they're in a shitty situation. They're like, well, it's not my fault. It's the economy or it's the government. And I think people are also afraid of just being the greater fool, where it's like, hey, I don't want to show any optimism or euphoria because then I'll lose money. I need to be a pessimist and cynical. But I think it just makes sense to stay optimistic over long periods of time. I mean, that's really how you build wealth. Like,
It's
yeah,
more
every now and then the
profitable.
Michael Burrys of the world get right, but I don't know, man. I'm more optimistic than pessimistic, even in the face of all this AI stuff. What do you guys
yeah,
think?
well said. Well said. I mean, it's hard to, like you said, remain optimistic sometimes, even for people like us that tend towards optimism. Like, every day I get on, and I'm like scrolling through my feed. I'm like, what am I doing? What am I doing? Why am I looking at this stuff? And I'm getting mad, and I want to like reply to people, and I want to like quote tweet them, and I have to pull myself back because it's just like probably that all that negativity just isn't helpful ultimately to your own mental health long term.
Yep.
That's funny you say that, Trav, because yesterday, someone notorious for posting crap came across my feed and I was quote tweeting it. I was like, man, I'm part of the problem. I should not give this any more engagement. And I ended up canceling it, deleting it, and not posting it. But like, it's just so easy to want to get out there and just correct people because
Yeah.
there's so much crap information and advice that's getting pushed around. And people with way bigger followings than me that have no professional training are just posting junk and you want to correct it. But you're right, Trav. There are times where it's just like you don't want to fall into it any more than you already are. Because it does make me mad.
Yeah.
Well,
One day,
I think
mad.
one that was worth going after was your stuff about Dave, what Dave Ramsey was talking about. Do you want to just mention this? I think this is one that was absolutely needed.
Well, yeah, with Dave Ramsey, he's so big and so many people listen to him, millions of people, that I feel like, okay, I can set the record straight on this one because so many people are affected by it. And this went viral last week. Like Dave Ramsey went off on a crazy rage with when this guy called in saying, "Hey, I saw on your website there was an article saying that for a 30-year time horizon for early retirement, I should be more at a 3-4% withdrawal rate from my portfolio versus a higher withdrawal rate. And Dave went off yelling at the camera or whoever he was yelling at, basically saying, I can't believe someone put this crap on my website. The withdrawal rate of 8% is fine if you're making 12% a year in your portfolio and you have a 4% average inflation rate. That leaves you 8% to withdraw. Completely elementary, flawed logic, by the way. That's not how the math works in retirement planning, but that's besides the point. And so he basically was telling this caller that he's okay to pull an 8% withdrawal rate. And there has been extensive research put out there into the world on safe withdrawal rates from portfolios. So essentially what most people have come up with is around 4%. The 4% withdrawal rate, it's made famous. I think it was Bill Bengen or William Bengen. I might be saying his name wrong, but basically he put it out there and made it famous. And so the nuts and bolts of it is an 8% withdrawal rate will work if you only live like 10 years. If you're trying to have money to sustain you for 20, 30, even more than 30 years, which is very likely if your financial independence retire early, then you need to be at a much lower withdrawal rate, maybe 3-4%, right? And then not only that, Dave is making the asinine assumption that everybody is going to be 100% in stocks going into their retirement, which is not a very smart thing to do. Any good financial advisor or planner is going to be moving money out of stocks into safer assets going into retirement. So, there are so many things that affect how your withdrawal rate will look. Things like when you have drawdowns in your portfolio in retirement. If you have drawdowns, like say the 2000 people that retired during the 2008 financial crisis, if they were pulling 8% withdrawal rates on that, they would have been screwed, basically. Yep. So when you have these bear markets in your portfolio matter when it comes to being in retirement. So there's a lot of flawed logic behind Dave's reasoning. It's not based in mathematics at all. It's based in feelings and lack of education around retirement planning. And so that's my soapbox. I'll get off it now, but it's dangerous advice, in my opinion.
I completely agree. I mean, it's just wild that he's so arrogant and cocky and just demeaning when he talks to people. And some of the things you hear him say, it's like, I'm gonna stop.
And it's funny because his employee or whoever it was, George was his first name. I don't know his last name, but he works for the Ramsey group or company. And he was right. Like his information that he put out on Ramsey's website was correct because he was looking at a 30-year time horizon, somebody retiring early. And that's, I just feel bad that he probably got a butt chewing from Dave Ramsey for putting out this article that is factually correct. So that sucks.
Yep. Well, the boomer mentality and just that aggressive, like I know better than you, and I'm going to talk down to everybody that calls in on my show. I think people are kind of moving past that. We'll see. I mean, he's built an incredible business, and I respect him for that, and at least trying to help people get better. But when you approach it that way, it's just ridiculous.
Here's what I'm going to say. Dave Ramsey's great if you're wanting to budget, if you're wanting to pay down debt, if you're wanting to change your mindset around money, right? He's right about a lot of things in terms of if you keep making dumb decisions, you're not going to get anywhere. And unfortunately, a lot of people keep making decisions that aren't in their best interest. Mm-hmm. And that stems from financial psychology, money psychology. But when it comes to investing, he is not the best person to listen to. I mean, his investing advice is not great. It's I would even argue it's dangerous, to be honest. I mean, his thing is a fund portfolio, 100% stocks all the way, like through retirement, going into retirement, all of it. And I just don't think that that's smart. Personally.
He also, and he's also endorsed like mutual funds with like 4 to 5% annual fees that hold the same stuff as an ETF with a 0.5% or lower fees. It's like there's some real low hanging intellectual fruit to be picked there that he's not picking. It's like, come on, man.
Yeah. He's out of touch when it comes to that stuff.
But it's like Chris said, it's the arrogance, I think, and that's where his own blind spots and just the way he treats people is appalling. But
and people seem to watch it still. So I don't know.
He has helped people in a lot of other ways with, trying to get out of credit card debt and saving and things like that. And I think that's where he's built his niche, and that's where, he's done positive things. But then, like, for some reason, he has to be an a-hole everywhere else.
Once people get through the baby steps or whatever he calls them, come on over to We Talk Money. We'll take you from there.
Yes.
We got your back, and we won't yell at you.
That's right. Unless you're doing something stupid, then we're going to really get in your face.
Even if you do something stupid, it's okay. We'll work through it.
That's right.
That's right. Just stay in the game. Remember our rules. Number 1, don't do anything that will permanently take you out of the game. Number 2, realize there's always another trade or opportunity right around the corner. And number 3, I don't know. Do we have a number 3? Let's come up with a number 3. 3 absolute
don't let your
rules
emotions get to you.
Don't let your emotions get to you. Yeah. I think just develop the mindset, right? Like focus on the mental game first and foremost, because that will sustain you over a career of investing, a lifetime of investing.
Well said.
Cool. All right, guys. Anything else y'all want to talk about before we wrap it up?
No, I feel bad. Did I get too heated talking about Ramsey?
Very well deserved.
Okay, well then I'm good. As long as people heard me and don't take 8% withdrawal rates.
Right. Yeah. You're relatively contained versus me, who I could have gotten kind of fiery there. One day I'm going to come for some of these people. One day I'm going to do a whole series of videos coming after the worst of the worst.
I think you
guys,
should.
If you want to see and hear that, just like this up, share it with somebody, leave us a comment, tell us who you want us to go after. And again, we're not going to do like attacks on the person. We're going to do it on the bullshit that they're spewing. So
that's right. Attacking the message, not the messenger.
Exactly. And everybody makes mistakes, and like even we make mistakes, right? But
sure.
I think that somebody posted not too long ago, oh, why are professionals bringing other professionals down and basically kind of reacting to their reaction videos and stuff like that. And it's like, well, in this day and age with social media, someone's got to right the wrongs, because otherwise, I mean, you got to stand for something. And so I think that the way that we do it, and what's really important to us to correct, to save people from making super expensive mistakes, I think it's worth doing. And I think people appreciate it as well.
Agreed.
Well said.
I think that's a great place to leave it off. So, all right, guys, thanks for watching. Make sure that you are a few things. Number 1, make sure you're subscribed to the Daily Dough, our newsletter that comes out every Monday, Wednesday, and Friday. I'll pull that up here so you can check it out. We do briefs, the 3 of us, on every episode or every issue. Also, go to wetalkmoney.com. Make sure you are subscribed to the podcast, the new YouTube channel, all that good stuff. And then if you want to trade and invest alongside of us, go to wetalkmoney.com/community, and you can come into our Discord channel, get our live classes, all that good stuff. And yeah, I think now's a good time to start sharpening those skills coming up on the end of the year here. And we want to help you make 2024 an amazing wealth growing year. So
absolutely.
All right, guys. Well, thanks for watching, and we will catch you next time. See ya.